Dheeraj Nim, the forex strategist and economist at ANZ Research, joining us. Hi, Dheeraj. Good to have you on ET now. The dollar index, of course, has seen quite a bit of surge, already perched very close to that 105 mark. Do you see more strength there?
Thank you for having me here. I think our house view is that the dollar index could be at 105 by the end of this month, by the end of this quarter. So at least in the near term, we do not see significant upside, but let's just be mindful, 105 is not a very easy level for any currencies in the emerging market space.
Okay, Dheeraj, so that was as far as the dollar index is concerned, your house view is 105, but we are seeing an impact, of course, on the rest of the currencies wherein they are weakening as well. What's the house view as far as the INR or Indian rupee is concerned? It's very close to the record low level of around 83.29 thereabouts. You see it weakening further to 84, 85?
Not really. So we think that the rupee could remain in this tight range of about 82.80, 82.90 to 83.10, the recent lows that have been established. I think my own forecast for September end is 83 per dollar. But let's just be mindful that there's a couple of more headwinds out there apart from the dollar strength, namely the crude oil prices, which have just surprised everybody on the upside. So I think that the rupee in the most near term could maintain a bit of weakening bias, but we expect the Reserve Bank of India to remain present in the market to smooth out any volatility. They would not allow any sharp depreciation to happen in the rupee, at least now when domestic inflation concerns are to the forefront.
Right. Dheeraj, this is Vinny joining in the conversation as well. Also, what we want to understand is in terms of the yields, right? Whether you look at the US yields, they have risen as well, with the 2-year, 10-year yields as well. And what about the Indian yields as well, bond yields? What are you looking at in terms of that? What is your view on those as well?
Look, at the moment, I think one of the key headwinds for the yield is high inflation, and the inflation outlook, which is not looking very great compared to what it was a couple of months ago. That I think is a key factor that could drive Indian yields slightly higher. Apart from the fact that this quarter generally tends to be where there's a lot of government supply of bonds being offloaded in the market, so that could also have some impact on the yields. Now, there is also the factor relating to the Reserve Bank of India's rate action. Of course, we know that they have dialed up their hawkishness, but so far they have been maintaining the situation with a tight leash on liquidity. We do not yet know if at all of this will materialize into a rate hike, but of course the risks have risen. So I think a few factors together are pointing to upside in the yields in the near term, at least till this global storm on the dollar strength and what happens to the Fed rate trajectory is firmly behind us.
Dheeraj, what you're saying, there is a bit of a hawkish commentary and there's a case further for that upside on hikes or rather yields. What does it do to your own assumption of the rate hikes which are impending not only for US but for India as well? Because in India, at least we thought the rates have peaked already and it's a pause button that the governor has hit. Do you see that stance changing somehow?
So that's a tricky question. So for the US, we think the Fed is done with its rate hikes. That's our baseline view. But for India, as of our most recent analysis, we have identified that the food inflation problem that the Reserve Bank of India is grappling with is not all that transient. There is at least 60% of the food CPI basket, which shows remarkable persistence of inflation. These are items like cereals and pulses, which are quite weighty by nature, which means that, if inflation in these items does not come off sufficiently, they may have implications for household inflation expectations, second round effects of inflation, which the RBI will probably have to respond to. So at the moment, we are not expecting a hike by the RBI in our baseline. We are looking at more like a risk scenario, the odds of which have certainly risen because we think that this persistent aspect of food inflation is not easing sufficiently. We think that, the Reserve Bank of India perhaps can't do a lot to tame these food price pressures. It's beyond their influence. But, the public policy lever would be the most important tool here.
You're not changing your view when it comes to hikes by RBI, but are you changing your view with respect to when the rate cuts were impending? Because at least, at the start of the year or mid of the year, the expectation was that the US Fed probably might start mid of next year or end of next year. What happens to those assumptions? And in India, we were actually expecting it in first quarter of next year itself.
So I was always towing the view higher for longer. For India, we're not seeing any rate cut before Q3 of 2024, and the risk is that this will get pushed out further if the inflation problem does not get resolved over the coming months. I think globally that is going to be the theme. The rates are going to remain higher for longer, which will be guiding the broader financial market. So we are, as everybody else, I think the risk is that any possibility of rate cuts, whether in the global space or locally in India, will have to be pushed out.
Dheeraj, correct me if I'm wrong, but I do understand that you look at the Chinese economy also very closely. And the data that we are seeing hasn't been positive at all. What do you make of the overall demand trends right now in China and where that economy is headed?
Look, I think we have made our views pretty clear on various platforms, but we think that China has sort of entered in a phase where its economy is going to structurally slow over the next few years, and even cyclically there is some weakness. So, of course, it does not bode well for regional growth, for global growth, and of course demand for various commodities. The effect is going to spill over into a lot of other markets as well. But what happens in India's case is that if at all there is a significant dampening effect on, let's say, global commodities. Well, we're not seeing it right now, but if at all it happens, it's a positive tailwind for the Indian economy because we are net importers. That's one way Chinese slowdown can help us. But on the face of it, the slowdown in China is a bit of a growth headwind for the entire region, and India is not accepted in that picture.
Okay, Dheeraj, thank you so much for joining in with us this afternoon on ET Now, giving us an understanding on the currency market. Where do you see that headed as well? What is the expectation there? Thank you so much for joining in with us. But, what's